All right, ठीक है. Good morning, friends. Today we are dealing with the provisions of Section 115 JC. Well, you've now already understood how to compute tax under different heads of income. You've seen the carry forward and set off. You've seen the clubbing provisions. You've also seen the income that are exempt under the Act. You've learned how to compute the gross total income. What you have also learned is the deductions under Chapter 6A. After that, what you find is the total income. Once you deduct deductions under Chapter 6A, anything that remains is nothing but your total income. Now that total income is subjected to tax, and the tax rates are either the normal rate of tax specified under the Finance Act of each of the year, or it is the special rate of tax. So like Section 112, 111A or 112A, you've got some special rate of tax and your income would be either taxable at normal rates or the special rate. But there is one more provision which, creates a deeming fiction, whereby even if you do not have any tax payable, or you have a tax payable which is lesser than the amount calculated under Section 115 JC, you'll end up paying a minimum tax which is required by 115 JC. I'll explain in detail. So see what happens. An assessee who is earning income and if he has got any income from either the exempt sources, if those income are exempt, he might have book profit, but then government doesn't stand to gain anything. And therefore, there was an introduction of something called as alternate minimum tax. We've got something called as got some problem. All right, we've got, government coming up with a new concept, and that is alternate minimum tax. Now, how does this alternate minimum tax work? When your regular income tax, so it starts with, first it overrides all the other provisions of the Act, and therefore we have got a non-obstante clause which says, notwithstanding anything contained in this Act, where the regular income tax payable, it's the regular income tax payable which you have to compare by a person other than a company. So regular income tax payable by a person other than a company is less than the alternate minimum tax. So provisions of Section 115 JC would apply only in case of a person other than a company. The reason being, in case of a company, they are governed by 115 JB, and this particular alternate minimum tax in case of company is called as MAT, that is minimum alternate tax. Now it applies only in cases where the regular income tax is less than the alternate minimum tax. And therefore now what assumes importance here is we have to find out what is alternate minimum tax. Now alternate minimum tax is nothing but tax at the rate of 18.5% on the adjusted total income. Now therefore, again, since now I know that alternate minimum tax is 18.5% on adjusted total income, I'll have to figure out what exactly is adjusted total income. Now adjusted total income coincidentally is defined in the same section, and it says alternate adjusted total income, it shall be the normal total income as increased by deductions claimed under Section 80 H to 80 RRB. So basically what you have to do is you have to first compute your normal total income, that is to be computed as per the provisions of the Act, and you got to increase it by any deduction that you have claimed under Section 80 under the heading C of Chapter 6A, which covers 80H to 80 RRB, right? All of these deductions got to be added back to the total income in order to find out the adjusted total income. Then deduction claimed under section 10AA and deduction claimed, if any, under section 35. So all of this got to be added. Only if you add all of this, you get adjusted total income. Once you get the adjusted total income, you got to apply the rate of 18.5% on such adjusted total income. And if that 18.5% is greater than your normal tax that you have calculated under the provisions of the Act, then what you end up paying is minimum 18.5%. We'll try and understand this by way of an example, but for the time being, understand, you end up paying a minimum of 18.5% if you have claimed any of the three of the deductions. If you've claimed these three of these deductions, you would end up paying minimum 18.5% of the adjusted total income. See, and if if you don't have any of these deductions covered by chapter 6A or 10AA or 35AD, then whether 115JC applies, the answer is categorically no. It would apply only if you've got deduction under these three items which I have discussed. If you don't have any of the deductions under the three items, you're not going to be subjected to 115JC. Let me explain you the logic of this. What happens, the businesses or the assessees who are claiming deductions under chapter 6A and the heading C covers mostly the profit linked deductions. So you have got AT, IA, IB, right? A series of sections which are not covered by your syllabus. Your syllabus covers only three sections of this heading C. The first one is ATJJAA, which we had dealt yesterday only. The second one is ATQQB and ATRRP. So these are the only three sections which are covered by the heading C in your syllabus. So we are dealing with only these three adjustments as far as your examination is concerned. You're not to be concerned with ATIA, IB or the other profit linked deduction. They're not covered by your syllabus. Don't expect a problem wherein you'll have an adjustment on ATIB or ATIA or any other section of this particular heading C of chapter 6A. You have got only three sections and you would have adjustment only on these three sections as far as section ATH to ATRRB is concerned. Now, ATJJAA dealt with the cost of new employees that you employ during the year. ATQQB dealt with the royalties on the books. For deduction, flat deduction of 3 lakh rupees was received in case where you receive an amount in lump sum or the actual amount received, whichever is less. Similarly, ATRRB dealt with the patents, royalty received on use of patent or transfer of patent, that was governed by ATRRB. Now, if you have any of the deduction, see what could happen. Let's assume, you have got an income of 30 lakh rupees. And what you do is you claim deduction under chapter 6A, under the heading C of rupees, let's say 10 lakhs. Assuming that you claim a deduction of rupees 10 lakhs. So now you've got a total income of 20 lakhs. You also have a business covered by 35 AD and therefore, you claim capital expenditure worth rupees 15 lakh rupees, assuming out of this income of 20 lakhs. So ultimately, you have a total income of 5 lakh rupees. You're an individual, you end up paying nothing, no tax, absolutely. So you have earned 30 lakh rupees, but you haven't paid a single rupee as tax to the government. And therefore, government would want you to pay some tax in your happy times. happy times meaning you have got book profit but no taxable profit. Then you would wonder, then what is the sense of giving these deductions? If I am supposed to pay tax, I am eligible for the deduction and yet I am supposed to pay tax, then what is the sense of actually giving that deduction? See, understand, even government requires taxation or tax to be collected periodically. When you are in your good times, you should pay tax. That is the entire objective. But at the same time, we have to promote certain industries, we have to promote certain activities, and therefore we are giving deduction to the assessee to commence that activity, to undertake a particular activity. Now, if you have earned income and you are paying minimum alternate tax, it is right that you're not getting the full benefit of the deduction. But then what was proposed is that whatever you pay as minimum alternate tax or the alternate minimum tax, AMT under 115 JC would be allowable as tax credit in subsequent year or years. So what happens is you're paying tax on the adjusted total income, but that tax is not consumed. You get a credit of that tax, and the tax credit could be claimed for 15 assessment years subsequent to the year in which it is paid. So you've got this tax credit and you have to consume that tax credit from your normal income tax. So whenever there is a regular income tax payable by you, in those years you could claim credit of any of the alternate minimum tax you have paid in the preceding year. We'll understand this when we come to an example, but for the time being, understand it is nothing but a tax credit. You are paying tax in advance and you'll get a credit of this amount in the subsequent year. So you don't lose anything in this. The only thing you lose is you pay tax in advance, so you lose a bit of your liquidity, but otherwise than that, there is no loss here. You claim the deduction, and you would get the benefit of the deduction. The only thing is you'll have to pay alternate minimum tax on the adjusted total income. Again, let me repeat. 115 JC would apply only if the regular income tax payable is, if the regular tax is less than the alternate minimum tax, right? Regular tax less than alternate minimum tax. If this condition is not satisfied, JC doesn't apply. Second condition is, you should have claimed deduction under Chapter 6A or under Section 10AA or under Section 3580. If you have not done either of it, you are not again covered by JC. There is one more provision which grants exemption to small assessee. Assessees who are, earning income to the extent of 20 lakh rupees, in case if they are individuals, HUF, AOP, BOI or AJP, in that case, so artificial juridical person, body of individual, association of person, HUF and individual. In case of these types of person, if the adjusted total income does not exceed 20 lakh rupees, if the adjusted total income, not the normal total income, if the adjusted total income does not exceed 20 lakh rupees, again 115 JC does not apply. So 115 JC does not apply. One, if the regular tax is not less than the alternate minimum tax. Two, you haven't claimed any deduction under those three heads, that is Chapter 6A, 1, and then you've got 10AA, and then you've got 3580. So if you're not claiming any deduction under those three heads, again JC would not apply. And the third condition is where the ATI of an individual HUF, AOP, BOI or AJP is less than 20 lakhs, 20 lakh rupees or less. If it exceeds 20 lakhs, only then would the provisions of alternate minimum tax apply. Now what you've got to do once you come to a conclusion that the regular income tax is less than the alternate minimum tax, in that case you will have to compute tax as per the both the regular way as well as the alternate way. Once you compute both the taxes, thereafter what you do is you pay alternate minimum tax and claim credit of the tax which you have paid in excess of the regular income tax. In the process, what is also required by 115 JC subsection 3 is that you should obtain a report in form 29C from a chartered accountant. So as a chartered accountant, you have to certify the correctness of both the adjusted total income and the alternate minimum tax. So you will have to certify both of it in form 29C and furnish this report of a chartered accountant along with your return of income. Once you've done that, once you've discharged your liability of alternate minimum tax, what you could do is you could claim the credit of the alternate minimum tax in next 15 assessment years. So for 15 assessment years, you could claim the credit. Beyond that, you would not be able to do that. Let's take up an example and then understand the concept in a better way. See, Mr. X, an individual, sets up a unit in SEZ in the financial year 2015-16. So the unit in SEZ is set up in 2015-16. Now the moment you see this, you understand, since the unit is in SEZ, he would be eligible for a deduction under section 10AA. Now 10AA grants deduction. We have already dealt with 10AA when we dealt with income not forming part of total income, and 10AA gives an exemption for 15 years, right? For first 5 years the exemption is unconditional. For next 5 years, again the exemption is unconditional, but to the extent of 50%. For the first 5 years, it is 100%. And for the next 5 years, you get a conditional deduction subject to, creation of the SEZ RRA. Tell me whether the assessee gets 100% deduction in first 5 years on the entire income of SEZ, or whether it is only the income from exports that is eligible for deduction under 10AA. Just recollect and tell me whether you get 100% deduction on the entire profit or only on the exports, profit relating to exports. In the financial year 15-16, just leave your answer into the query box. In the financial year 15-16, for production of washing machine, so he is producing washing machine in an SEZ. The business has commenced in 15-16. The unit fulfills all the conditions of section 10AA of Income Tax Act 1961. So conditions have been fulfilled. Now, during the financial year 18-19, he has also set up a warehousing facility. So during financial year 18-19, what we learn is he has set up a warehousing facility in some district for storage of agricultural produce. So what he is doing is he's storing agricultural produce in a warehouse facility. Now you understand, you've dealt with section 35 AD and storage of agricultural produce. If you commence a warehouse operation which is engaged in storage of agricultural produce, you get the deduction under section 35 AD. There are couple of deductions related to storage. One of them is warehousing facility for agricultural produce. The other one, can you name the other one? Storage facility, which is covered by 35 AD. So in the district of Tamil Nadu, for storage of agricultural produce, it fulfills all the conditions of section 35 AD. Again, the warehousing facility have been commenced from 18-19. Well, under 35 AD, I must tell you that there is no other requirement as far as approval is concerned. You can always claim deduction in respect of all the capital expenditure that you incur for the warehousing facility. So the capital expenditure in respect of the warehouse amounted to 75 lakhs, including the cost of land. So what they say is you have the capital expenditure in respect of warehouse amounting to 75 lakhs, including cost of land of 10 lakhs. Now, whether this cost of land would be deductible under section 3580, it is a capital expenditure. We're talking of capital expenditure deduction in respect of specified businesses, whether cost of land would be deductible. Then the warehouse became operational with effect from 1st April 2019, and the expenditure, so it became operational. The commencement of operation have become, it has begun in 1920. Financial year 1920 is the year you look out for. Until then it was capitalized. And the expenditure of rupees 75 lakhs was capitalized in the books on that date. Now there is some more information that is provided, and relevant details for financial year 1920 are as follows. Profit of unit located in SEZ. The total profit, now what you have got here is the total profit, which is 40 lakhs. Export sales of above unit 80 lakhs. Domestic sales of the above unit 20 lakhs. And what you've got is profit from operation of warehousing facility before considering deduction under section 35 AD, which is 1 crore and 5 lakhs. Before 35 AD and after considering all of the provisions, you've got a profit of 1 crore 5 lakhs. You are supposed to calculate AMT under section 115 JC payable by Mr. X for the assessment year 2021. So now look at this, friends. Tell me what is the amount of profit that would be deductible under section 10AA of the Act. A lot of you have answered correctly. 10AA would cover only profits relating to exports. So you'll have to find out of the total profit how much is related to export. You've been given the total amount of profits. You've got the export sales and you also have the domestic sales. Now what is the profit attributable to export sales? Very simple. Can you just find it out for me? One crore. Out of the total turnover of 1 crore rupees, 80 lakh rupees is from export sales. So what is going to be the export profits? What is the amount of export profit which would be deductible under section 10AA? Quite simple. Yes, Vaishnavi, you are absolutely right. It is 32 lakh rupees will be attributable to export sales. So how do you compute that? You have got 40 lakh rupees of total profit divided by 1 crore, right? And multiply it by 80 lakhs. So the moment you do that, you get the amount of export profits. So export profit would be 32 lakhs. Tell me now whether this entire 32 lakh rupees would be deductible or whether only 50% of the amount of 32 lakh rupees would be deductible. See, we have got an information. So we now understand that there is 32 lakh rupees of export profits. We've got 32 lakh rupees of export profit that we are aware of. The pro rata profit is 32 lakhs. Now whether 100% of 32 lakh rupees would be exempted or deductible under 10AA, or whether it would be 50% of 32 lakhs. Whether you got to deduct 100% or 50%. Now, wonderful, Kristen, what you say is right. Pratik, what you say is right. No, you deduct 100%. Why? You deduct 100% of this export profit for the simple reason that, for the first 5 years on commencement of the operations in an SEZ, for the first 5 years, you could claim 100% deduction. For the next 5 years, you claim 50% of the deduction. And for the last 5 years, you claim deduction to the extent of 50% subject to creation of SEZ RRA. We've discussed this provision way back. You just have to brush it up once more and you'll recollect everything. So this particular unit of Mr. X has commenced the operation in 15-16. So you've got 15-16 as the first year, first previous year, 16-17. 17-18, 18-19 and 19-20. Now 19-20 is the fifth year and therefore you claim 100% of a deduction. So whatever you earn on export profits would be available as deduction under section 10AA. Now therefore what it means as a corollary, what it means here is, see, your total profit is 40 lakh rupees. Out of which you claim a deduction under section 10AA of rupees 32 lakh rupees. So what is taxable is 8 lakh rupees. Yes, am I right? Now again, the moment you see that there is a deduction under section 10AA, the moment there is a deduction under section 10AA, you should have an indicator that you will have to calculate tax as per 115 JC. 115 JC, again I'm repeating, it applies in case where the assessee claims deduction under section 115, deduction under any of the sections covered by heading C of chapter 6A, 2, 10AA, 3, 35AD. Since Mr. X has already claimed deduction under 10AA, you will always calculate tax as per 115 JC because he satisfies one condition. Then, as far as 35AD is concerned, 35AD gives you a deduction in respect of capital expenditure that you incur. Now somebody said, yes, land is not included. What else is not included? Which other capital expenditure is not included for deduction under section 35AD? What are the other capital expenditure of an eligible business which are not allowable as deduction specifically? There is something called as subsection 8, clause F of 35AD. Now Kristen says building. No, building is covered. The cost of building you can deduct out of the deduction for building is available under 35AD so long as that building is used for the purposes of the specified business. building is covered. So you are going to take deduction of 65 lakh rupees. 65 lakh rupees is eligible here because capital expenditure in respect of warehouse amounted to 75 lakh rupees, out of which cost of land is 10 lakh rupees. So now you logically assume that, out of the 75 lakh rupees of capital expenditure, 10 lakh rupees is towards land. So 65 lakh rupees is towards the building of the warehouse. Now this 65 lakh rupees is deductible because what else are you going to have in a warehouse? Unlike the cold chain facility, which is again eligible for deduction under section 35 AD, now the cold chain facility would have a lot of machinery. Since it's a chain, it covers transportation of goods as well. However, in case of warehouse, you would have land and building, which would be the the material cost of the project. Most of the project cost would go there. My question, Payal, is what are the other capital costs which are not deductible under section 35 AD? So one of them is land. What are the other capital costs related to eligible project or the specified business? Right, Mansha, what you say is absolutely right. You do not get any deduction for goodwill. So any capital expenditure that you incur in the nature of goodwill, that is not allowable as deduction under section 35 AD. Anything else apart from goodwill? So you don't get any deduction for land, you don't get a deduction for goodwill. What else? So you could always have a adjustment like this, that the total capital expenditure was 75 lakh rupees, then out of which land constituted 10 lakh rupees, then he paid goodwill to another warehouse owner of rupees 5 lakhs. So in that case, only 60 lakh rupees would be eligible and not the entire 75 lakhs. Is there anything else apart from land and goodwill? Well, I guess you'll have to read the provision again carefully. So what is covered by clause F of subsection 8 of 35 AD is, you don't get deduction for cost of land, goodwill and financial instruments, right? So if you, make a deposit for the construction of warehouse, that would not be available as deduction. Now the actual cost of building would be available as deduction. Actual cost of machinery, equipment would be available as deduction. What is not available as deduction is land, goodwill, financial instruments, and any capital expenditure that you incur in contravention of section 40A3. So even this is a latest addition. If you incur any cost which is in the nature of exceeding 10,000 rupees, but not through an account paid check, account paid bank draft, or through the specified modes, that amount is also not eligible for deduction under section 35D. So what do you think? What we should be concerned with as far as deduction out of this 1 crore 5 lakh rupees is concerned? Out of the 1 crore 5 lakhs, what is the amount of deduction that we are claiming under section 35 AD? Kristen says royalty. Well, Kristen, royalty would be revenue expenditure, right? As far as 35 AD goes, it gives deduction only for capital expenditure, for nothing else. Which capital expenditure would be deducted out of 1 crore 5 lakh, sorry, and how much? How much is the deduction Mr. X is going to get under section 35 AD out of this 1 crore 5 lakhs? Well, your total deduction from 1 crore 5 lakh rupees under section 35 AD would be restricted to 65 lakhs. That is nothing but the cost of building. Right, so capital expenditure in respect of warehouse was 75 lakh rupees, out of which cost of land was 10 lakh rupees, and therefore you're going to deduct 65 lakh rupees out of this 1 crore 5 lakhs. The warehouse became operational with effect from 1st of April 2016. Now this information, this information is relevant. Why? Because anything that you incurred prior to the commencement of the specified business would be available as deduction in the year in which you commence the operation. So that is what is clarified under section 35 AD subsection 1. They specifically say that you claim all the expenditure that you have incurred prior to the commencement in the year in which you commence the operation, provided you have capitalized the expenditure in the books of accounts. So if you not capitalized it and you have already claimed it as deduction under under any of the other sections of the act, you're not going to get any deduction. If you have capitalized it, you can claim deduction in the year in which you commence the operation. So capitalization is important. In this case, Mr. X has duly capitalized 75 lakh rupees. So he can claim deduction of 65 lakh rupees. So let me just see what is the total income therefore. In case of Mr. X, the total income, as far as the business profession, income from business profession is concerned, he has earned 40 lakh rupees as profit from the SEZ unit, out of which you computed that 32 lakh rupees is deductible under section 10 AA being export profit, and therefore remaining 8 lakh rupees would become taxable. Thereafter, as far as 35 AD business is concerned, he has got a total profit of 1 crore 5 lakh rupees prior to deduction under section 35 AD. We claim 65 lakh rupees as deduction under 35 AD, and the remaining 40 lakh rupees would become taxable. So the total income is 48 lakh rupees in case of Mr. X. Now his tax liability on this 48 lakh rupees would be the normal tax computed at the relevant rates. Now since he is an individual, so you got to figure out first whether he is an individual. The answer is yes, he is an individual. Now we have not been given the age of the individual, and therefore we assume he's not a senior citizen. So unless and until he's a senior citizen, we go by the normal rates. You'll be given the information that his age is 65, 70. If it is so given, you've got to apply those rates. Goes without saying, I don't need to explain you that. Anyways, so tax at regular rate would be 12,52,500, and then you pay also the education cess. So education secondary and higher education cess of 4%, so 50,100. Now understand, as far as 35, the business covered by 35 AD is concerned, had you not claimed deduction under section 35 AD, what would have happened? So understand, you incur a capital expenditure to the tune of 65 lakh rupees, and it is not for the specified business. You have a building in respect of your business, which is not a specified business under section 35 AD. Now, if it is not a specified business, this amount of 65 lakh rupees would not be available as deduction. But then what would be available as deduction instead of the entire 65 lakh rupees? What deduction would you claim on the amount of expenditure that you incur on construction of a building or purchase of a building, and that building is utilized for business? What is the available deduction that you have? What is the available deduction? Well, Ganga has made a very good query. I'll come to it in a short while. You answer my question, that if a building is used for the purposes of business, and if it is not a specified business, what is the deduction that you get in respect of a building? moment you answer my question, you are going to understand the logic of one very important provision of 115 JC in calculating the adjusted total income. My question to you again is, I have incurred 65 lakh rupees on construction of a building for my business. What is the deduction that is available on the amount of expenditure that I have incurred on such building while computing my profits and gains of business? Anybody? Fantastic question. It is the amount of depreciation. You claim depreciation on this building. So had it not been a specified business under section 35AD, I would have been eligible for deduction under section 32 of the amount of depreciation. Now once once the depreciation is available, I don't claim deduction under 35AD. Or if I'm claiming deduction under 35AD, I'm not claiming depreciation under section 32. Now, as far as 115 JC is concerned, what it says is, if you claim deduction under any of these provisions, heading C of chapter 6A or 10AA or 35AD, if you are claiming deduction under any of these heads, you will have to calculate the alternate minimum tax. And the tax would be computed on the adjusted total income. Now, adjusted total income, what we said is, it would be increased. So what we are doing here is, in this example, my adjusted total income would be my normal total income to be increased by the deduction that I have claimed under 10AA and the deduction that I have claimed under section 35AD. So I'm going to add all this up. I'm going to add 48 to the amount of 48 lakh rupees. I'm going to add up 65 lakh rupees. And what I'm also going to do is I'm going to add up 32 lakh rupees. Once I add it up, what I get is adjusted total income. But understand now, here is a twist. As far as the business under section 35AD is concerned, if I would not have claimed this deduction, I would have anyways got depreciation under section 32. And therefore, what the Act says? The Act says that the adjusted total income should be computed by adding the deduction under section 35AD, but by deducting or reducing the amount of depreciation allowable in accordance with the provisions of section 32, as if no deduction under section 35AD was allowed. So there they create sense by, allowing the amount of depreciation out of the adjusted total income. Because anyways, if you would not have claimed 35AD, you would have got the amount of the normal depreciation under section 32 of the Act. So that is what we have to do while we compute the adjusted total income. Let us move to the adjusted total income. The normal total income was 48 lakh rupees. Add to that, 32 lakh rupees from 10AA and 65 lakh rupees, is the amount of deduction that you have claimed under 35AD. So this is to be added, but then you have to deduct the depreciation under section 32. I hope you're getting the logic of deduction of depreciation. As if 35AD does not exist. The deduction under 35AD, if you have not claimed it, you are anyways eligible for deduction of depreciation allowance. The depreciation allowance would be 10% of rupees 65 lakhs. Depreciation on building is 10% of the cost. As far as the land is concerned, you're neither eligible for depreciation nor are you eligible for 35AD. So land is out of question. The remaining sum, we have assumed that it is building, and of the 65 lakh rupees, you could claim 10% as depreciation. If it was a building used for less than 180 days, well, you could have claimed only 5% of the amount. But then, since we know, we are already aware that he had commenced the operation from 1/4/2019. Therefore, we claim full rate of depreciation, and that is 6.5 lakhs. So we are adding a net amount of 58 lakh 50,000 rupees And the adjusted total income therefore is 48 lakh rupees plus 32 lakh rupees of 10AA plus 58 lakh 50,000. The adjusted total income therefore arrives at 1 crore 38 lakh 50,000. Now this is this is exceeding 50 lakh rupees. Not only is it exceeding 50 lakh rupees, it is also exceeding 1 crore rupees, right? And therefore, I just don't pay the minimum or the alternate minimum tax, but I also pay the amount of surcharge because, this adjusted total income is deemed to be my income of the current year, deemed income. So we are discussing deeming fiction here. If you look at the provision of 115 JC, you'll come to the conclusion that it is nothing but deemed income. The adjusted total income shall be deemed to be the total income is what I get here. It is the deeming fiction which has been created, and since adjusted total income is deemed to be the total income, surcharge would be applicable. So as far as the normal income was concerned, no surcharge was payable. But now, with the adjusted total income exceeding 1 crore, surcharge would be payable at the rate of 15%, and you pay the alternate minimum tax at the rate of 18.5% on the amount of adjusted total income, right? So you pay 25,62,250. In addition, you've got surcharge of 3,84,338 and an education cess of 4% on the amount of alternate minimum tax plus surcharge. So the total AMT payable by you is 30,64,451. So now you will have to decide whether the alternate minimum tax is greater than the regular tax. When you look at the regular tax, you were required to pay only 13,02,600. Now this is obviously lesser than the AMT that is payable. AMT is payable at the rate of 18.5%, and it works out to 30,64,450. So what is recoverable from you is the amount of AMT. Right now you pay the amount of AMT, but then you would say, then what is the sense of deduction? Well, in this case, what would happen is you pay 30,64,450. Your normal tax liability is 13,02,600. The remaining balance, that is 17,61,850, would be carried over, and it would be available for deduction. It would go on to reduce your normal tax liability of the subsequent year. You could carry over the amount for 15 assessment years. If next 15 assessment years, you could carry this amount of AMT and the credit would be available. Now, somebody asked me, what is the logic of carrying over? Then why do you need to collect if you are giving a tax credit? Well, what happens is government gets tax in advance. Government is collecting tax in, when you have got a book profit. So it might so happen that in the subsequent year, the assessee would not have a book profit at all, right? And therefore no normal tax is payable. So at least what the government has done is they've recovered the AMT. And it also keeps a check. Understand, when you get such deductions which are flat in nature, 10AA, there's a tendency of increasing the profit of exports related transaction. There's a tendency to increase the profit of the specified business. So in order to tap that, tap on that tendency, again 115 JC comes very handy. What, as far as the carry forward is concerned, carry forward is covered by section 115 JD. JD says that whatever excess you pay in terms of AMT over the regular income tax would be carried over and set off in accordance to subsection 5 and 6 of 115 JD. And no such carry forward would be allowed beyond 15 assessment year. So up to 15 assessment year, carry forward and set off of the excess of AMT paid over regular income tax is available. So the tax credit would be available for 15 years. And in the subsequent year, whenever your normal tax is greater than the AMT, you could claim the credit of this amount that you've paid in excess of what you were required to pay. Ganga had asked me a very good question, and the question was, sir, to compute AMT under section 115, oh, sorry, not this one. Now her question is, sir, in provisions it is given that assessee who claims deduction under section 35 AD cannot claim deduction under section 10 AA or chapter 6A. Then why it is taken here? The answer is simple. The businesses should not be common. You know, he is not supposed to take 35 AD on the warehousing business, and he's again not, you know, and simultaneously also taking 10 AA for the same warehouse business. The businesses of Mr. X are distinct. For warehouse business, he is taking 35 AD. For manufacturing business, you know, he is taking 10 AA. Had he taken, the deduction for 10 AA for warehousing business, that would not have been allowed. Here, both the businesses are distinct, and therefore both the deductions would operate simultaneously. Do you get this, friends? So 35, 35 AD and 10 AA could go simultaneously. Not if they are not for the same business. You get section 115 JC and JD. You could have a an adjustment. It could be an hidden adjustment. Whenever you see deduction being claimed under section 35 AD or 10 AA or chapter 6A under section 80 JJAA, you have to compute the alternate minimum tax as per 115 JC. That is part of the problem. Even if it is not asked for, it is part of the problem. If you were to compute the tax liability, what is asked in the problem is to compute the tax liability. How do you compute the tax liability? You compute it using the normal rates as well as the rate of AMT provided by 115 JC. So even if it is not asked, you have to compute it to find out the actual tax payable by the assessee. I hope you get this provision. Do not miss it out. I've tried to make it simple. Well, as far as the marginal relief is concerned, I don't think marginal relief would apply here. See, the adjusted total income is 1 crore 38 lakhs. So it is well over 1 crore 2 lakhs some odd where the break even is achieved. So you don't have to think about marginal relief over here. But had it been, very, very close, marginal relief would have to be computed. So Shaikat is asking, can I change alternate minimum tax to regular tax and use vice versa every year? No, see, any tax that you pay under alternate minimum tax would be available as credit in subsequent year against the normal income tax only if, normal income tax exceeds the amount of AMT payable under section 115 JC. The alternate minimum tax is compulsory. See, what Aman is asking is, when the provisions of relaxation is given, why will the person go for alternate minimum tax? It is compulsory. If you satisfy the conditions, you will have to compute alternate minimum tax. And if the alternate minimum tax exceeds your regular income tax, you will have to pay as per the AMT provisions. And claim credit. Subsequent year, you could, carry over the amount that you paid in excess of the normal tax that you were liable to pay. Yes, marginal relief would apply, but then in this case, there is no question of marginal relief. Since the AMT is well above 1 crore, the adjusted total income. Understand, in some cases, foregoing a deduction is a better way, to deal with a situation. Let's assume in one of my cases of assessee that I have dealt with, what happened is he's a writer, and therefore what was available to him was a deduction under section 80 QQB, and he had a lot of income from short-term capital gain, which was subjected to 111A. Now, 111A requires you to pay tax at the rate of 15%. Now, if I claim 80 QQB, AMT would apply. Since it is into the heading C of chapter 6A, AMT would apply if I am claiming deduction under section 80 QQB. Now, this rate is 15%, but then if AMT applies, I end up paying 18.5% on this amount. So sometimes, not claiming a deduction is also same. So it was like the deduction was a small amount of 10,000 rupees, and just because of 10,000 rupees of deduction under section 80 QQB, I had to pay 18.5% on the sumptuous 1 crore rupees of capital gain. I'm not going to do that. I'm going to forego the deduction. If I do not claim the deduction, well, I do not satisfy the conditions for attracting 115 JC. I have to claim deduction under those three heads. If I am doing that, only then 115 JC would come into play. So sometimes it is, logical to not opt for deduction. Alright, so I've taken up the queries as well in respect of 115 JC. Any specific query that that you seem to be worried about? Can AMT of succeeding assessment year be adjusted against the credit of AMT? No. Payal, what Payal is asking is whether this credit of AMT of 17,61,000 would be available against the AMT payable of the subsequent year. The answer is no. You have to claim this credit against the normal income tax which is payable by you and not AMT payable by you. The provisions of section 115 JD is very clear. It says set off to the extent of excess of regular income tax over the alternate minimum tax. No set off is available against the alternate minimum tax. Set off is available only in respect of excess amount of regular income tax over the AMT. Good question. Can you please explain if the carry forward of tax credit AMT is adjusted against next year normal tax payable? I guess Meenakshi is asking me a question which relates to how it would be set off. So see, let's assume your normal tax in the current year is 1 lakh rupees and the AMT that you have computed is 1,25,000 rupees. You end up paying AMT because it is greater than the amount of normal tax. Now this 25,000 rupees which you have paid in excess, over and above the normal tax. Normal tax was anyways payable by you, right? What you have paid in excess is only 25,000. So what government says, okay, you're paying more, so claim a credit. Now in the subsequent year, what happens is your normal tax is 1,25,000 and your AMT is 1 lakh, right? Now in this case, what is the excess of the normal income tax over AMT? It is 25,000. So what you can do here is, the credit that you have got of the AMT would be eligible for set off against this 25,000 in the subsequent year. Yes, Ganga, you're right. If that is a big loss. If in all succeeding 15 years, you never came, close or close to the AMT, or whether AMT was always higher than the normal tax, no credit could be claimed of the AMT that you pay. But generally it would not happen. When you look at these provisions of 10 AA or 35 AD, these are as far as 35 AD is concerned, it is available only in the first year, right? And as far as 10 AA is concerned, it is available in fragmented manner, right? For the first 5 years it is 100%, next 5 years it is 50%. So as you go in subsequent years, you would always get a chance wherein the normal tax would be greater than the AMT. Even as far as the deductions are concerned, when you talk of 80 JJ AA, the deduction is available only for 3 years. Do you get it, friends? So this is AMT. Do not forget to calculate AMT, even if it is not asked for, even if you get a problem of calculating the tax payable, you have to compute AMT in order to complete the solution. So let us move ahead and take up some more problems. नहीं हो गया शुरू हो गया Ganga, again, what about the excess credit of AMT after 15 years? It would lapse. Nothing could be done about it. You have given donation to the government. Yes. Mr. M, let us take up this problem. Mr. M, a resident individual. So he's a resident individual. Right now, whenever you're solving a problem, right, which includes computation of total income and tax liability, the first and the foremost thing you're doing is finding out the residential status of the assessee, because unless and until you do that, you're not defining the scope of the total income. And therefore, first and the foremost thing, find out the residential status. What is it? So if it's given, no question, no need to worry. But if you've got any of the information either by way of an adjustment or in the first paragraph of the problem, you have to first figure out whether he is a resident or a non-resident, and thereafter try to figure out which head the income would fall into. So first step would be to find out the residential status. He is a resident and he is an individual. Age 53 years. So when you get something like this, aged 53 years, he is not a senior citizen. Then provides consultancy services in the field of taxation. So he is providing consultancy services. Fine. His income and expenditure account for the year ended 31st of March 2020 is as follows. So we've been given an income and expenditure account. Let us look at the income expenditure. You've got consultancy fee of 58 lakh rupees. Now, when you look at the problem, you try and decipher what exactly the information is all about. You've got consultancy fee of 58 lakh rupees. He is a professional. Anything in excess of 50 lakh rupees would involve an audit, right, for the assessee. So you are clear with, yes, an audit is applicable. 44 ADA would not apply to him. By share of profit from HUF, 55,000. So share of profit of HUF. HUF has already paid tax on to the amount of profits. So you're not going to tax it twice. You have a specific section under section 10(2) of the Act. You're not to pay any tax onto the share of profit that is exempted. Then you've got interest on bank fixed deposit of rupees 25,000. So while you are looking at the problem, you're also thinking about the solution. Interest on fixed deposit is deductible. The amount of interest is deductible to the extent of 50,000 rupees only in case of senior citizens. So 80 TTA, I guess, or TTB, would give a deduction of 50,000 rupees only in case of resident individual being senior citizen. Now, he is not a senior citizen. Since he is not a senior citizen, you are not giving any deduction. Thereafter, so this would be, again, it would not be taxable as profits and gains of business profession, but it would go into income from other sources because his business is that of professional consultancy, and this doesn't seem to be a professional income. Thereafter, interest on income tax refund. So what he has got is a refund of income tax, and on that income tax he has also got interest. We're going to deal with the interest provision in the subsequent lecture, but for the time being, 26,000 rupees is the amount of interest, and this is going to be again taxed under income from other sources. Then what you see again further is salary of rupees 4 lakh, motor car expenses of rupees 88,000, depreciation debited in books 87,500. Most of the times when you see an item of depreciation, usually you will have an adjustment. So what you do is you just add up the depreciation to this particular excess of income over expenditure of the profits, and thereafter deduct the allowable depreciation under section 32. So this is a adjustment that you have to make, in most of the problems. Medical expenses rupees 70,000. Now medical expenses, if they are related to business, allowable as deduction. If they are not related to business, it is not allowable as deduction. Mostly it would qualify to be a personal expenditure. So you have to, while you are reading the problem, you are just trying to figure out what kind of an adjustment could be there, and when you read the adjustment, you make a final conclusion. Purchase of computer. Now this item you are well aware, the purchase of computer is not eligible for deduction completely. It's a capital expenditure debited to profit and loss account. So not available as deduction, only the depreciation would be available. Then you have got bonus. When you see the word bonus, what should strike to your mind is section 43B, right? So bonus would be eligible for deduction only in the year of payment, or if you pay the amount before the due date of filing return of income, right? So it is subjected to 43B. There are a few of those items like statutory dues which are subjected to 43B, right? So bonus is one of them. General expenses 1,05,000, office and administrative 1,15,000. So we don't see any problem here. Let's move on to the adjustment. We come to the first adjustment. Following other information related to FY 1920 is given. Salary includes a payment of rupees 22,000 per month, who is in charge of marketing department, right? So to a sister-in-law of the assessee. Mr. M is paying, to the sister-in-law 22,000 rupees per month. However, in comparison to the similar business, the reasonable salary for marketing supervisor is 18,000 per month. So what the information given to you is that relative of Mr. M, who is working with Mr. M, so she's the sister-in-law, who is paid salary of 22,000 rupees. However, the reasonable salary is 18,000 rupees. So what is the amount of unreasonable salary? For 4,000 rupees per month. Now, what to do with this information? Whether this is, disallowable, 4,000 rupees into 12, whether that would be disallowed from the amount of salary. Do you think so? I'll just show you the provisions of section 40A2. Section 40A2 deals with such a situation where payment is made to relative. And then you tell me whether anything would be disallowable because of this payment of salary in excess of the reasonable amount. Whatever is unreasonable, whether it would be disallowed. So Payal says yes, 4,000 per month for 12 months would be disallowed. Christian also says that it would be disallowed. Well, in that case, you've not read the provisions of section 48(2) carefully. What 48(2) says, in case of an assessee who incurs expenditure in respect of which payment is made to a specified person. Now, who is a specified person in case of an individual, right? Who is a specified person? It is the relative of the individual who is a specified person. Now, whether relative would cover all the relatives? The answer is no. It has been defined under section 241. There is no definition of relative under section 48(2). We don't have a specific definition. Yes, Mansha, you're right. Sister-in-law is not a related person. She is not a relative covered by the definition of section 241. And therefore, you're not going to disallow anything even if it is unreasonable. It is only the payment made by individual to relative would be covered by the disallowance under section 48(2) and not every person. Relative in relation to an individual means spouse, brother, sister, or any lineal ascendant or descendant of that individual. So you have already seen this definition while you were discussing gift, lineal ascendant, descendant, section 56 to 10. You've already discussed what is lineal ascendant and descendant. But then, only in case of a relative covered by definition of section 2 into bracket 41, would there be a question of disallowance under section 48(2). Here, she is not a relative and therefore no disallowance got to be made. I hope you get it. Next, so therefore no adjustment. As far as the first adjustment is given, it is a little confusing for you. Just that how good you have understood 48(2). It only proves that you've not seen the definition of relative. So when you go through the problem, you are just recollecting all the provisions. You are just trying to apply what you have learned. Once you have the logic in mind, application becomes simple. Thereafter, going to item 2 of this, return down value. Let's go to the adjustment 2. Return down value of asset as on 1st of April 2019 are as follows. It says motor car 25% used for personal use, rupees 3,50,000. Furniture and fittings, rupees 80,000. So what we have been given is the opening WDV of asset. Right, we already have a depreciation which have been debited in profit and loss account or the income expenditure account of rupees 87,500. Now what they give us is opening WDV as per the Income Tax Act, and into that they say that 3,50,000 is that of motor car. So motor car, you've got 3,50,000 of opening WDV. What you also have is furniture and fittings. Furniture, the WDV is 80,000. While I read the problem, I know at least one more adjustment in respect of depreciation. What is that adjustment in respect of depreciation that I know from this part of the problem, the information that I have on screen? There is at least one more item of adjustment in relation to depreciation. So while I read the problem carefully and while I decipher the information, I'm creating a solution in my mind. I know that I've debited the purchase of computer straight to the income and expenditure account. So this is going to be disallowed because it is capital expenditure debited to profit and loss account. So unless and until you have a specific section like 3580, you're not going to claim the deduction and you're not going to get it. So computer, as far as computer is concerned, it would be disallowed from here, but you could claim depreciation in respect of computer. Let me see if I've got some information on computer, right? I'll just check whether I've got some information about computer. So computer was purchased on 5th of June 2019. They say it was purchased on 5th of June 2019 on credit. Now whether it is cash or credit doesn't matter, right? It is purchased. The total invoice was paid in the following manner, right? It was purchased on 5th of June, used for more than 180 days, eligible for depreciation, not eligible for an entire deduction, right? 90,000 entirely would not be deductible because it is capital expenditure, but then, as far as the actual cost of the asset is concerned, covered by section 43 into bracket 1, tell me what is the actual cost of the asset, whether it is 90,000 or whether it is something else. So the total cost was paid for by the assessee in the following manner. Rupees 18,000 paid in cash as down payment on the date of purchase and remaining by way of an account pay check. So he has paid 18,000 in cash and remaining 72,000 rupees have been paid by check is what we know. Now tell me what is the amount of the actual cost of the asset first. The cost under section 43(1) for the purposes of claiming depreciation on computer. What is the actual cost? Whether it is entire 90,000 on which I need to claim depreciation at the rate of 40%. In case of computers, you've got a rate of depreciation that is 40%. So whether it is 90,000 into 40%, whether it is 90,000 into 20%, or whether it is something else. So understand, I don't see a answer by now, as far as 43(1) is concerned, the actual cost of the asset would not include so much of an amount which is paid in cash or by way of a mode otherwise than by way of account pay check, account pay bank draft, electronic fund transfer in excess of 10,000 rupees. What he has done is Mr. M has paid 18,000 rupees in cash, which is in excess of 10,000 rupees, and therefore Sanjay, actual cost, yes, I've got a few answers now, actual cost would not include this 18,000 rupees. Actual cost would be 72,000 rupees. You're right, Pratik, you're right, Pooja. And 18,000 rupees would not be forming part of actual cost. Well, Mansha, 10,000 rupees in excess of cash payment in excess of 10,000 rupees is not disallowed here. Understand, it does not form part of the cost itself. Right? So 72,000 rupees would be the amount of actual cost. Let us therefore compute the eligible depreciation. What is the eligible depreciation when it comes down to the Income Tax Act under section 32? So we've got motor car of 3,50,000, we've got 80,000 rupees of furniture, and what we also know now is 72,000 rupees of computer. So motor car is eligible for 15% depreciation, furniture 10% depreciation, and this is eligible for 40% depreciation. This motor car is the opening motor car. Remember, there is the amendment in case of rate of depreciation of motor car is concerned, within that specified period from August to March. You have to just check it out, go through the recent amendments. It's important. Let me just check out the amendment. The amount of depreciation that I could claim. See, 3,50,000 rupees, and you've got an adjustment, and that is 25% used for personal purposes. So since I've got an adjustment like that, what I'm going to do is I'm going to claim only 75% of the entire amount of depreciation on motor car as expenditure, as depreciation allowance, right? The personal use of asset got to be excluded. So with motor car, I've got one additional hidden adjustment, and this has got a second repercussion. By the time, I discussed the amount of depreciation allowable, can anyone tell me what this adjustment has got an another repercussion on which of the item? Motor car 3,50,000 into 15% into 75% would be allowable. Furniture entirely used for business 10% would be available. 72,000 rupees of computer, although 90,000 rupees paid, but since 18,000 is paid in cash, only 40% of 72,000 rupees would be eligible for depreciation. Let me just figure out therefore what is the amount of eligible depreciation. So the eligible depreciation therefore on motor car, as I told you, it is 39,375. On furniture, 10% of 80,000, 8,000 rupees. On computer, 72,000 into 40%, right? So 40% of 72,000 rupees would be 28,800. I hope you have understood why we have taken 72,000 rupees. Do not forget to exclude the amount paid in cash in excess of 10,000 rupees. Only and only if it is in excess of 10,000 rupees, you got to exclude. Right, so in a day, one time in excess of 10,000 rupees, then you have to exclude, else it would form part of the actual cost of the asset. So total depreciation allowable is 76,175 as against debited, 87,500. So 87,500 would be added, and what would be allowable is 76,175. What you can do is you could also take the net of it as disallowance. Now, so do you get this as far as the adjustment second is concerned? Can you tell me which is the other item which this particular adjustment here? A very small information is given to you, but in all probability you will forget to use it on something else. So look at the problem. It's a very intelligently carved problem. When you are into an examination environment, you would have to focus very hard when it comes down to reading the problem carefully. You spend some time on reading of the problem. Don't be in a hurry to, figure out the solution immediately. What you do is you read the problem carefully, try and link all of the items, try and solve it in the rough first. And thereafter, what you could do is you could make it fair. Motor car 25% used for personal purposes, and therefore you disallow 25% of the depreciation. But there is something called as motor car expenses. Now this motor car expenses is the depreciation you're disallowing. You are also disallowing the motor car expenses. You're right, Christian. Very good. If you fail to notice the relationship between these two items, then if you just treat it as far as depreciation is concerned, you'll go wrong. And therefore 25% of 88,000 would also be disallowed, right? So you have to make use of this information. Let's go ahead. We've got next line of adjustment. Medical expenses includes family planning expenditure of rupees 15,000 incurred for employees, which was revenue in nature. So medical expenditure out of the 70,000, he has incurred 15,000 rupees on employees, right? On employees for the purposes of family planning. Now, whether this is allowable as deduction, especially when you know that the assessee is an individual, whether this amount of 15,000 rupees is allowable as deduction. Can you tell me whether it is allowable as deduction? right, Harsh, it affects motor car expenses. As far as the family planning expenditure is concerned, no, both A and B, try and answer both A and B here, both the adjustments, because I get delayed responses, so I'm unable to figure out whether by the time I answer, your answer would come after I answer the question. So try and answer both A and B simultaneously. Family planning expenditure rupees 15,000 incurred for employees, whether it is allowable as deduction in case of an individual, number one. Yes, Mansha is absolutely right. She has read the provision very, very carefully. Well, Mansha, you've been very, very instrumental. I've seen you from day one. You've been extraordinary as far as deciphering provisions are concerned. So keep it up. Medical expenses for his father, rupees 55,000. So, see, total 70,000 rupees, out of which 15,000 towards family planning and 55,000 rupees towards father. Expenditure of father. Now, expenditure on father would not be eligible for any deduction because it is personal expenditure. But then what else it would be eligible for? Chaikat, you don't allow it for 5 years, you allow only the capital expenditure for 5 years, and that too in case of companies alone. You're not allowing any deduction for family planning expenditure in case of individual. So just don't go by family planning expenditure, it is not allowable in all the cases. Only to company, yes. Medical expenses of his father, rupees 55,000. The age is given, right? The age exceeds 60 years, so, he's a senior citizen, father is a senior citizen. He's not covered under any medical insurance policy. Rupees 2,500 incurred in cash and remaining by credit card. What to do with this information? We have dealt with one provision the day before yesterday, and we have dealt with in detail. I guess somebody should come out with an answer as to what we should be doing with this information. See, one thing is sure, out of the 70,000 rupees, entire 70,000 rupees is going to be disallowed. Why? Because one, it is family planning expenditure incurred by individual. So it is not company, therefore disallowed. And two, 55,000 rupees is personal expenditure. So we are disallowing the entire 70,000 rupees for sure. But whether there is an allowance, some allowance here by way of item B. Yes, Harsh is right. Father under section 80D, you could claim expenditure of under section 80D. Now this is medical expenditure, Manshan. It is not preventive healthcare checkup, right? So we're not concerned with preventive healthcare checkup. This is actual medical expenditure incurred on father. Yes, Christian. Yes, Pooja. It is 50,000 rupees that is going to be allowed. And why? Because one, he's a senior citizen. Otherwise, had he not been a senior citizen, this medical expenditure would not have been allowed. Had you known that the father's age is 59 years, it can be, no, it cannot be, right? Practically it cannot be, but then fine, because his own age is 53. So father's age is 65 is what here. Had he been 59, practically couldn't be, but then had he been 59 years of age, this medical expenditure would not have been allowed. It is allowed only because he is a senior citizen and he is not covered any other medical insurance plan. Since he is not covered under any other medical insurance plan, the total amount of expenditure that the assessee makes for any other parent would be allowable as deduction under section 80D. However, the total amount of deduction could never exceed 50,000 rupees. So 50,000 rupees in case of parent and 50,000 rupees in case of regular assessee. But then the information that is given is that 2,000 rupees, 2,500 rupees is incurred in cash. Again, this 2,500 rupees would not be allowable. But anyways, it is not allowable because the total expenditure is 55 and you got to restrict it to 50,000. So what is available here is only 50,000 rupees of deduction. 2,500 rupees would be anyways not allowable because you are disallowing 5,000. What you could always claim is that the 5,000 disallowance also contains this 2,500 rupees of disallowance, and remaining amount has been paid by credit card. Since you have paid the remaining amount by credit card, it is allowable. So 50,000 rupees of deduction under chapter 6A. So you now know that there is something, the effect would be on section 80D chapter 6A. Fantastic. Had he been 59 years of age, no deduction would have been allowed. It's only because he is a senior citizen, you could claim deduction. I'll move on to the next adjustment. You tell me whether if the father was also covered by 80DD, that is disabled dependent, whether he could have claimed, the 75,000 rupees in addition to 50,000 rupees. Let's move ahead. I'll move ahead. You give me an answer. Then bonus was paid on 30th of September 2020. Now look at this adjustment here. They say that the bonus was paid on 30th of September 2020. It is an important information that is given to us. Bonus is 25,000 rupees actually paid on 30th of September. What we know that the assessee is subjected to tax audit because he's got an income exceeding 50 lakh rupees and he's a professional. Since he's a professional, we are going to do a tax audit and therefore he'll have an extended due date for filing return of income. We have already seen the due dates for filing return of income. Whether the bonus has been paid prior to the due date of filing return of income or whether it is paid after the due date of filing return of income. If it is paid after the due date of filing return of income, you are not going to claim any deduction under section because of the provisions of the section 43B. But whether it is paid prior to that date. So answer as far as the third adjustment is concerned, 36(1) IX, that is item 9 of 36(1), it says that in case of bona fide revenue expenditure incurred by company for promoting family planning would be allowed as deduction. Capital expenditure incurred by company would be allowed as 1/5 of a deduction for succeeding for the current year and succeeding 4 years. The deduction is allowable only to companies and not to any other assessee. Do remember this. Do not forget. As far as 3B is concerned, you've got whole of the medical expenditure paid on health of any other parent. Right, and it does not exceed in aggregate rupees 50,000. Well, in respect of medical expenses, I had asked you whether he could claim a simultaneous deduction under section 80D and 80DD. Well, in respect of the same amount of expenditure, he cannot. If at all there is some other expenditure that he does in addition to the medical expenditure of the senior citizen, dependent father, He could also claim deduction under section 80DD. Well, here of the 5,000 rupees is not claimed deduction under 80D, and therefore he might become eligible for a deduction under 80DD as well, had it been a specified disability. We're not sure about it, whether it is a specified disability or some deadly disease that he is paying for. For the time being, he claims deduction only under section 80D. Well, Harsh, due date is 30th of November. That is because of the COVID scenario. The due date is 30th of November. Whether it under the regular environment also the due date is 30th of November. Anyways, he has paid well before the due date of filing return of income because he is subjected to tax audit, and therefore the deduction would be allowed. Next adjustment we have in the nature of general expenses. So when you look at general expenses, you see that general expenses have been debited to the extent of 1,05,000. Out of the 1,05,000, what they say is general expenses include commission payment of rupees 42,000 to Mr. X for promotion of business. Right, so commission is being paid for. Now, what we have not discussed until now are the provisions relating to TDS. But what you have already seen is section 40A IA. So what I'm giving you an information is that commission is, you've got to deduct tax on commission at the rate of 5% under section 194H. Right, so you got to deduct tax, and you haven't deducted tax under section 194H of the Act. So what the information given to you is that on this commission of 42,000 rupees paid to Mr. X, you have not deducted tax. So you have paid it without deduction of tax. What are the consequences? What would be the consequence here of this 42,000? Whether it would be entirely disallowed, or it would be disallowed at a specified rate, or whether it would be entirely allowed. You have got three options. Fourth one is none of the above. You could also have an MCQ like this, wherein general expenses include commission payment of rupees 42,000 without deduction of tax. Yes, tell me what should be done for adjustment number 6. What do we got to do? You have to be quick. Also answer in, leave a chat box answer in relation to adjustment number 7 and adjustment number 8. Now adjustment number 8, okay fine, you don't leave an answer. I'll tell you the logic of adjustment number 8. Mansha says only 30% of the sum will be allowed. Are you sure, Mansha? Well, Vaishnavi says it would be disallowed entirely. And Pratik says only 30% would be disallowed. So Pratik, you win the race. It is only 30% that is going to be disallowed. And not 30% allowance. Mansha, it is 30% of disallowance. Vaishnavi, assuming that Mr. X is a resident, only 30% is going to be disallowed under section 40A IA. Now, had the information been that Mr. X is a non-resident and you make a payment of commission, in that case alone, entire amount would have been disallowed under section 40A I of the Act. So try and read the provision carefully. So it is disallowed to the extent of 30% under section 40A IA. Do not disallow the entire 100%. Only what you got to disallow is 30%. I'll also share a walk around in respect of disallowance under section 40A IA while we discuss TDS. Provisions of TDS we are going to start from tomorrow. What I'm going to do is in respect of TDS, I'll try and make it in a question answer form so that it becomes interesting for you. TDS is one of the very as they say, TDS is TDS provision under the Act, and therefore what I'll try and do is frame different questions, and we'll go through the Q&A form to understand the provisions. I'll just share a walk around in respect of disallowance under section 40A IA. But for the time being, we are going to disallow 30% of this 42,000 rupees under section 40A IA. Next adjustment is in respect of he also receives gold coin from family friend on the occasion of marriage anniversary. Now it is not marriage, it is marriage anniversary from family friend on 15th of November. The market value of the coin on the said date was 85,000 rupees. So whether this is going to be taxed under section 56 to 10. For question whether it is going to be taxed under section 56 to 10. IA, you would disallow the amount if tax has not been deducted, or after deduction it has not been paid before the due date. What you disallow is only 30% of such sum, that is 40A IA categorically. Now Sanjay, gift of gold coins allowed. What do you mean by allowed here? We are talking of whether it is taxable or it is not taxable. Whether this 85,000 rupees would be taxable under section 56 to X. Gold coins received Yes, Shaikat, you're right. So the entire amount, would be taxable. Why? See, 56(2)(x provides for in case of any movable property that you receive in excess of 50,000. So whether he has received the gold coin worth rupees, exceeding 50,000, and the answer is yes, he's received more than 50,000 rupees of gift. The entire amount is going to be taxed. Why? Because he has received it from a non-relative. Family friend is not a relative, and two, it is not on occasion of his marriage, but marriage anniversary. So we are, had it been on the occasion of marriage, it would have been exempted, it would not have been taxable. But here it would be taxable. So you're right, it would be taxable. Harsh, you're absolutely right that he is not a relative. And therefore we are going to tax the entire amount. So most of you have answered it. Let us see the solution therefore. And we find out the tax payable. See, always remember what has been asked in the problem. Compute the total income and the tax liability. So you are to compute the tax liability also. And I've also told you, that you will have to check for 115JC if you see any of the item related to 10AA or 35AD or, as far as heading C of chapter 6A is concerned. So let us have a look at the solution. So profits and gains of business or profession. We're computing profits and gains of business and profession here. The excess of income over expenditure is taken as the basis. You You take it as a base. Add to that expenses debited but not allowable. So now how do you decide these heads? While you're reading the problem, you are jotting it down, and thereafter you put it into the solution together. So add and less, you will have to club them together. Generally, it gives a better presentation, although not required. It's not compulsory that you add and less together in groups. Add expenses debited but not allowable. Excess of salary rupees 4,000 rupees 4,000 per month to sister-in-law not disallowed, since sister-in-law does not fall within the definition of relative. This is what you told me, that she doesn't fall in the definition of relative, and therefore nothing is going to be disallowed. So even for an adjustment, it is a good practice for an adjustment which has got no effect on the total income. You write the logic of it. Right, so that the paper checker would understand that you've understood the provisions correctly. And while you're writing the logic, sometimes you realize that what the provision you're applying might turn out to be wrong, and therefore even for adjustments which have got no effect, you write a note or into the problem itself. Here, what I do is I write the solution in such a way that I am taking care of even the adjustments which are not having an impact on the income of the assessee. So I'll write a 0 out here. As far as motor car expenses is concerned, for personal use, 25% is going to be disallowed. 22,000 therefore would be added to the income from business or profession. Depreciation, we are going to consider it separately, and therefore 87,500 entirely disallowed. And thereafter, whatever is allowable, I'll claim it as deduction separately. Medical expenses, 15,000 available only in case of company, 55,000 personal expenditure to be disallowed. Purchase of computer, capital expenditure to be disallowed. Bonus, it has been paid before due date, and therefore nothing is disallowed under 43B. Thereafter, as far as commission was payable to the one of the agents, Mr. X, 30% of it was disallowed. 30% of 42,000 works out to 12,600 to be added to the income of business. So we come to know that all the additions have got an effect of increasing the income to 52 lakh 7,600. From 49 lakh 25,000, we have gone up to 52,000 7,600. 52 lakh 7,600. But then, this 49 lakh 25,000 also includes certain other income. These got to be considered separately. So I'll have to deduct that. What else I'll have to deduct? I'll have to deduct the amount of depreciation. Since I added the entire amount of depreciation debited to profit and loss account, what I do is I'll just reduce the amount of depreciation which is allowable under section 32 of the Act. Right? So 76,175 to be deducted. Also the income which are taxable under other heads. So either the exempt income, most of the time, you'll have other income which would come in, right? And therefore, 55,000 rupees of exempt income credited to profit and loss account, you'll have to deduct it from the income. Interest on bank deposit, 25,000. Interest on income tax refund, 26,000. Both of them, covered under income from other sources. Right, and this is anyways exempt under section 10(2) of the Act. So as far as income from other sources is concerned, you have got 25,000 towards fixed deposit, interest on income tax refund, and 85,000 rupees is the fair value of the coins taxable under section 56(2)(x). Now this is not forming part of the profit and loss account. We have this amount as an adjustment. So a total of 1,36,000 as income from other sources. Got a total income which is 51,61,425, out of which there is a deduction under section 80D of 50,000. We have discussed it. Medical expenditure on father, right? Parent, any other parents would be covered. So you have got a total income of 51,11,425 to be rounded off to tens. Therefore the total income is 51 lakh 11,430. Now computing tax liability here is a crucial game. You know, Pancha or somebody said, a couple of you have indicated that I should have computed marginal relief while I computed AMT. But then the AMT income was substantially higher and therefore I did not go for marginal relief. However, here I'll have to check it for marginal relief. You know, 51 lakh 11,430 is the total income. Now, out of the total income, we already know that the assessee is a regular assessee, so he can claim basic exemption of 2.5 lakh rupees. And for the first 2.5 lakh rupees, the rate would be 5%. For next, 5 lakh rupees, the rate would be 20%. And anything in excess of 10 lakh rupees, the rate would be 30%. So when you compute 5, 20 and 30%, you find out that the tax is 13,45,929. Right? 13,45,929 rupees is the amount of total tax, excluding surcharge and education cess. Now we are aware that when the income exceeds 50 lakhs, in the case of assessee, in the case of Mr. M, the income has exceeded 50 lakh rupees by 1,11,000 rupees, and therefore you end up paying 10% of surcharge. As far as if the income would have been greater than 1 crore, he would have ended up paying 15% of surcharge. 2 crores and above, not 2 crores and above, exceeding 2 crore rupees, 25% of surcharge. And exceeding 5 crores, the surcharge, the rate of surcharge is 37%, right? So whooping 37%, a surcharge on tax, right? So basically, this is the amount which defines the amount of surcharge to be levied. So this is the normal tax, and on this amount you will have surcharge, and on aggregate of both the amounts you will have the HEC, that is the health and education cess. Now since it exceeds only 50 lakh rupees and not 1 crore rupees, the rate of surcharge is 10%. Look at this. Do you all agree? Rate of surcharge 10%, 10% of this amount here, 13,45,929. So therefore, it works out to 1,34,593. The total tax therefore is 14,80,522. Now let's understand the logic of marginal relief. For those of you, who are scared of marginal relief, it is fairly logical. There is nothing that you cannot understand. It's very, very simple. On the contrary, let me tell you what happens. See, he has an income of 51,11,425. So how much have he earned above 50 lakh rupees? He has earned only 1,11,425, right? That's the only amount that he has earned above 50 lakh rupees. But then how do you penalize him for earning more than 50 lakh rupees? You are asking him to pay a surcharge of 1,34,593 on an increase of 1,11,425. Now this is draconian. You cannot ask somebody to pay more than what he has earned, isn't it? If he has earned 1,11,425, you cannot ask him to pay 1,34,593. So that cannot never be the intent of law. And if at all you ask him to pay 134, there would always be an inclination to reduce the income below 50 lakh rupees. And therefore what government said, in such cases where the surcharge is too heavy, in marginal cases where the income is increasing only by a small amount, what you can do is you could claim marginal relief. Now, how do you compute the amount of marginal relief? What they say is, first find out what is the amount of income exceeding the threshold limit for surcharge. So in case of this assessee, the threshold limit is 50 lakh rupees. Had his income been 1 crore, 1 lakh, the threshold limit we would have taken as 1 crore. Right? So in his case, the income in excess of 50 lakh rupees is only 1,11,430. Do you all agree? Yes. It is only 1,11,430 that exceeds 50 lakh rupees. Now, had his, the tax on total income of 50 lakh rupees, had his income been 50 lakh rupees, he would have paid 13,12,500 because up to 50 lakh rupees there is no surcharge, right? So he would have paid 13,12,500. But then now what is he paying? He is required to pay 14,80,522, right? 14 lakh he would have paid for an income up to rupees 50 lakhs, a sum of rupees 13,12,500. However, on his current income, he is required to pay 14,80,522. That is, he is required to pay an excess of 1,68,022. Right, on an income that has grown by 1,11,430, he is required to pay 1,68,022 rupees. So that is something, that is something you're not supposed to, punish the assessee for earnings a marginally higher income. And therefore, they say any amount, in excess of 1,11,430, that is the income exceeding 50 lakh, would be allowable as marginal relief. So what is in excess of 1,11,430? It is 1,11,430 minus 168,022. So 56,592 would be available as marginal relief in the case of the assessee. What it means? Essentially, government is going to take away the entire amount, 100% of the amount that you have earned above rupees 50 lakhs. Fair enough. At least they are not asking you for more. They are settling it at 100% of the amount. If they are settling it for 100% of amount, you are okay with it. No, you have to be okay with it. Marginal relief therefore would be 56,592. That is the difference between the amount in excess of 50 lakhs and the tax payable in excess of, on an income in excess of 50 lakhs. Therefore, for 14,80,522 less 56,592 would be your tax payable. Onto that, what you do is you charge secondary and higher education cess, and the remaining balance would be your tax payable. So 14,80,887 is what you are going to end up paying on an income of 51,11,430. Although when it comes down to marginal relief, I always feel that you end up paying 4% extra because education cess is levied after the amount of marginal relief. Then that is, you cannot change it. It is going to be like this. Do you get this? The concept of marginal relief. Any questions here? Any questions? Alright, I think there are no questions, but yet, before I move ahead, in case, when the marginal relief would be zero, what is the break-even income? Let me find out the break-even income wherein this marginal relief would be zero. At what amount of income, in case of Mr. M, would this marginal relief be zero? Let me just figure it out. So what I'll do is I'll just use one of the tools and I'll just try and find out the break-even point at which the marginal relief would be zero. And I get to know, at 51,95,896, this is the break-even point. So if the income exceeds 51,95,896, there would be no question of marginal relief. So this is the break-even point in case of Mr. M. But then this break-even point would change in case of by the age of the assessee. If he is a senior citizen, the basic exemption limit would become 3,000. If he is a super senior citizen, it would be 5 lakhs. For all of those assessee, the break even would be different. Again, the break even would also be governed by the special, those items which are governed by the special rate of tax. But then, understand that marginal relief is available only in marginal cases, not in all the cases. So any income, in case of Mr. M beyond 51,95,000 would not be subjected to marginal relief. Now, had his income been, 1 crore 10 lakhs, had his income instead of 51,11,430, if his income would have been 1 crore 1,11,430, in that case also he would have been eligible for marginal relief. The surcharge in excess of 1 crore, the surcharge in excess of 1 crore is 15%, right? So 15% is the surcharge, 4,26,889 is the amount of surcharge that you got to pay. But then when you look at the marginal relief, here on 1 crore rupees, had your income been 1 crore rupees, you would have paid 30,93,750 including surcharge. Amount including 10% surcharge, you would have paid 30,93,750. However, currently you are paying 32,72,818. That is, you are paying an excess of 1,79,068 rupees of tax. Your income that exceeds 1 crore rupees is only 1,11,430. You are paying an additional amount of 1,79,000 rupees when your income is only 1,11,000 in excess of 1 crore, just because of the increased rate of 5%. Here it is only 5% that has increased. 10% anyways you were required to pay. But now just because your income has marginally increased over 1 crore rupees, you end up paying 5% incremental cost. Now this incremental cost is subjected to marginal relief. Only the incremental cost is subjected to marginal relief. So here you have a concept of costing wherein the incremental cost would be subjected to marginal relief. You claim a marginal relief of the excess of amount payable that you have computed over the amount of excess income. So 67,638 would be allowable as marginal relief. Pooja, which kind of calculator? Non-scientific calculator would be only allowed and nothing else. So therefore, what you do is you just figure out marginal relief in all the cases where income has marginally gone above the limits on which surcharge is applicable. Let's go to problem number 2. Miss Geet, 38 years. So we get to know that she's 38 years of age, so not a senior citizen. Transfers the following capital asset during the previous year 1920. What are the assets transferred? Equity of A Limited, equity of B Limited, equity of C Limited, and house property. Right? Full value of consideration is given to you. The full value of consideration is 6,70,000, 8,000, 98,000, and 80,94,000. So you've got this full value of consideration, and 4 assets have been sold by Ms. Geet during the year. 4 assets sold, out of which 3 of them are equity shares. 1 of it is house property, and all the 4 assets have been acquired in the year 97-98. So all of them are long-term capital asset, right? You all agree everything is long-term capital asset. The fair market, now these are listed securities and therefore we've been given information regarding the listing also. Therefore 12 months would be the criteria as far as the equity shares are concerned. Anyways, it is held since 97-98 and therefore everything is long-term capital asset. So when you see this information, there are 2 things that comes to your mind. 1, it would become a long-term capital asset. 2, it is acquired prior to 1/4/2001. So you are going to take the fair market value as on the as on the first day of April 2001 for the purposes of determining the cost of acquisition. Now, Sanjay, I'll answer your question once I'm done with this problem. I'll just tell you how much is the marginal relief you'll claim. You'll get on income above 2 crores. Fair market value as on 1st of April 2001, 42,000 rupees, 54,000 rupees, 92,000 rupees and 10 lakh 50,000 rupees. Now look at this. Here you've been given cost of acquisition. You have also been given the fair market value as on 2001. Option is available to the assessee either to take fair market value as on 1/4/2001 or the actual cost of acquisition, right? Now what he would choose? He would choose the higher of both. You know, the cost of acquisition in case of equity shares of A Limited 1,000. However, the fair market value was 42,000 and therefore ideally what I would be choosing is this 42,000. I'm choosing 42,000, 54,000, 92,000. All of it, is greater than the actual cost of acquisition. So fortunately, all the fair market value as on 1/4/2001 is greater than the cost of acquisition that was actually incurred in 97-98. So everything would be the adopted value. The cost of acquisition would be the fair market value as on 1/4/2001. Now, what is also given is fair market value as on 31st of January 2018 as per the Bombay Stock Exchange. Now, this is something important piece of information. As far as the equity shares are concerned, they are now governed by 112A of the Act. Earlier, in the earlier regime, that is prior to the financial year 17-18, up to financial year 17-18, the entire long-term capital gain that arose on transfer of equity shares was exempted. There was a specific exemption that was provided for long-term capital gains arising out of equity share. But then the budget came in the month of February, the first day of February 2018. And in that year, what they did is they changed the method of taxation and they said now the exemption would go away. So you're not going to claim any exemption under section 1038 in respect of long-term capital asset being equity shares of a listed company, right? Since the provision was inserted on, the announcement was made on 1st of February 2018, had there been no grandfathering clause, markets would have been crashed. Markets would have crashed like anything because everyone would have sold their stocks and they would have booked the profit. And therefore, they devised a very intelligent scheme. And the scheme was to provide for deduction in respect of fair market value as on 31st day of January 2018. See, the announcement was made on 1st of February 2018. And therefore, the fair market value as on 31st of January 2018 would be adopted as the cost of acquisition. An option was given to the assessee to adopt it as the cost of acquisition. Now, whether he would adopt it or not would be his choice. Let us see when he would not adopt the fair market value as on 31st of January 2018. Well, he would not adopt it only when, in case if his cost of acquisition is greater than the fair market value. Fair enough, very, very logical. Let us see, therefore, let us move ahead. What is further provided to us? STT is paid on all transfers as well as the time of acquisition of at the time of acquisition of these shares. So it is an STT paid transaction both at the time of purchase and at the time of sale. Now the assets were purchased in 97-98. Practically, it cannot happen that STT was introduced from 2004 to the best of my recollection. Practically, no STT was paid on at the time of acquisition. But then, in the problem, they have said that it is paid at the time of acquisition. Stick to it. Ms. G had brought forward loss brought forward long-term capital loss pertaining to transfer of unlisted shares during the previous year 12-13. Right, so previous year 12-13, that is relevant assessment year 13-14, whether this loss would be available for set off in the assessment year 2021 is something you've got to figure out. Income of Ms. G from other sources is 2 crore 67 lakhs. So this would answer your question, Sanjay. We'll check it out. 2 crore 67 lakh 90,000 is the amount of income from other sources. Now you are supposed to find out, the total income of Ms. G, and you're also you would also figure out whether Ms. G has earned any long-term capital gain. Right. So first and the foremost, computing the cost of acquisition using the grandfathering option that is available under section 112A. Now this is to be read with section 55 to AC, right, as far as the cost of acquisition is concerned. Look at this. When you look at the actual cost of acquisition, it was 40,000, 51,000, 90,000. The fair market value was 42,000, 54,000 and 92,000. And therefore what you did is, like all the assets, what you did here is you took the higher of the two as the actual cost of acquisition. So actual cost of acquisition was 42,000, 54,000 and 92,000. Now, since the announcement was made on 1st of February 18, they said that you could claim deduction in respect of fair market value of that property as on 31st of January 2018. And therefore, the highest quotation was allowed, highest price of that day, that is 31st of January 2018, is allowed as adopted cost of acquisition if the assessee figures out that the fair market value is greater than his actual cost. So fair market value is 4,80,000 in case of equity shares of A Limited, 68,000 in case of B Limited and 30,000 in case of C Limited. You would notice that the actual cost of acquisition is greater only in case of C Limited. Here it is more than the fair market value. It can so happen, and therefore assessee is asked, whatever benefits you, you take that as the basis. But then sometimes what happens is, this could lead to the adoption of fair market value could lead to a loss. Let's check this out. With B, with equity of B Limited, what would happen? 54,000 rupees is your actual cost, isn't it? And 68,000 rupees is your fair market value as on 31st of January 2018. Up to 31st of January 2018, the income was exempt. Now what happens is you sell it at 8,000 rupees. So when you sell it at 8,000 rupees, the assessee would adopt 68,000 rupees and claim a loss of 60,000 rupees. Do you all agree with this? See the simple point I'm making here. If I allow you to adopt 68,000 rupees as the cost of acquisition, what you will do, you will claim a loss of 60,000 rupees based on the fair market value as on 31st of January 2018. And that is not the intention. The reason why that is not the intention, because up to 31st of January 2018, this particular transaction or the shares were not taxable at all. So I won't give you higher amount of loss just deeming by taking a deeming value as on 31st of January 2018. And therefore what they said that you got to take the actual cost of acquisition, compare it with the lower of fair market value or the full value of consideration. See, full value of consideration is 68,000. Fair market value is 68,000 as on 31st of January 2018. Full value of consideration is 8,000 rupees. So you got to take a lower of both, either of them, right? So what is lower? Lower is 8,000. And then compare this 8,000 with 54,000, and what you adopt as cost of acquisition is this 54,000. I know a bit confusing. It could be a bit confusing. Just try and try some examples. I'll deal with some of more of these examples. Let us proceed further and see what exactly is this grandfathering clause. Let us look at one share, one item at a time. 40,000, 42,000. Very, very simple. You take 42,000 as the cost of acquisition. Then you find that the fair market value as on 31st of January was 4,80,000. So 42,000 or 4,80,000, whichever is higher, you'll go with 4,80,000. You find that the full value of consideration was 6,70,000. So out of 6,70,000, what you're going to deduct is 4,80,000. So remaining would be your gain. So remaining is 1,90,000. 1,90,000 rupees is your gain from sale of equity of A Limited, and it is long-term capital gain. Now let us look at B. In case of B, you have got the higher amount, that is 54,000 rupees. You compare it with 68,000 rupees. Now when you compare it with 68,000 rupees, you are inclined to adopt 68,000 rupees as your cost of acquisition. Now if you take 68,000 rupees as your cost of acquisition, what would happen? Your sale value is 8,000 rupees and therefore 60,000 rupees with your loss. That is what you would claim. But then in substance, your losses should be restricted to 54,000 rupees less 8,000 rupees. So that is the actual cost, or the lower of fair market value and the full value of consideration. So you will stick to 54,000 rupees in this case and reduce the amount of full value of consideration. The balance alone would be the long-term capital loss. See, 8,000 rupees full value of consideration, cost of acquisition is 54,000 rupees, and therefore the loss is 46,000 rupees. In a nutshell, your governing criteria. If your full value of consideration is lesser than the fair market value as on 31st of January 2018, you are going to take full value of consideration as the cost of acquisition. So you are not going to claim more than the loss that you have actually incurred. The loss that you have actually incurred is 46,000. You are not supposed to claim a loss of 60,000. Right? That would be more than the loss that you have actually incurred. So that's the entire logic, of lower of 4 and 5. I hope you're getting it. Just try some of these examples on your own. You'll get it. The entire idea is not to give you a notional loss, benefit of notional loss. That is not the objective. Then, see, in the third case, 92,000, 30,000 rupees is the fair market value. The full value of consideration is greater than the fair market value. And therefore, but then here, since the actual cost is 92,000, you are not going to adopt 30,000 rupees. You are going to go ahead with 98,000 as full value of consideration. Cost of acquisition is your actual cost and not fair market value as on 31st of January, because it is not beneficial to the assessee. So the capital gain here would be 6,000. So you have earned, 1,90,000 rupees of gain on A Limited, 46,000 rupees of loss on B Limited, and on C Limited you have gained 6,000 rupees. Similarly, you have got house property, which is 80,94,500, the full value of consideration. The indexed cost of acquisition would be, in this case, it is the fair market value around 142,001 is 10,50,000 divided by 100 and multiplied by 289. That is the cost inflation index for the financial year 1920. Understand, no benefit of indexation is available for those assets covered by 112A of the Act. 112A does not give you the benefit of indexation. Indexation is allowable only in case of other assets. So 30,54,500 is your index cost of acquisition. Therefore, gain from sale of house property is 50,60,000. Now, this house property income is taxable at the rate of 20% under section 112 of the Act. Whereas income from equity is taxable under income from long-term income from equity is taxable at the rate of 10%. The rate is reduced to 10%, friends, and therefore the benefit of indexation is not available. Long-term capital assets are taxable at 20%. You're already getting a concessional rate, and therefore the benefit of indexation is not available in case of such concessional rates. Now, this gain is taxable at 10%, and therefore any loss that you have carried over from the preceding year, you would not be inclined to set it off against this loss first. You will set it off against the loss which attracts higher income tax. Now the rate which the asset which attracts 20%, you would set off the entire loss against 20% tax. So therefore, I've been given an information that she had a loss of 47,94,000 rupees during the previous year 12-13. Now 12-13 is available in 19-20. 8 years is barely complete, 7 years. Therefore, I could claim this loss. You could carry over for 8 years in case of capital loss is concerned. So 47,94,000 entirely would be available as set off against the gain of 50,60,000. Similarly, I have also incurred a loss of 46,000 rupees here, right? And that is also something I'll set off against the higher rate long-term capital gain. So intra-head adjustment entirely is in my hand. Similarly, setting off of the carry forward loss under the same head is also in my hand. Which rate income I reduce it with. Then, therefore, the long-term capital gain would be of shares 1,90,000 and 6,000. That is 1,96,000 is my income which is taxable under 112A. Thereafter, under section 112 of the Act, I'll be required to pay tax on 2,20,000. See, 2,20,000 rupees. And the normal income that is also given in the problem itself, it is 2,67,90,000. So my normal income is 2,67 lakhs, on which I end up paying 78,49,000 rupees of tax. That is the normal income tax rate. On section 112 income, I am required to pay 20% tax. Right, the rate is 20%. 2,20,000 into 20% is 44,000. And in respect of income arising on 112A, I am required to pay 10% of tax. Now, some might think I made an error here. It should have been 19,600. The answer is no. It is not 19,600. It is 9,600 only, because tax under section 112A is paid at the rate of 10% on gains exceeding rupees 1 lakh. So what is the gain exceeding rupees 1 lakh? It is 96,000, and therefore I end up paying 9,600 only. So do not forget again, friends, to deduct 1 lakh rupees while you calculate income under while you calculate tax under section 112A. 112A is relatively of a new origin, and therefore you can always expect something like this to come in your paper, right? Try and meticulously understand 112A and the grandfathering that I have explained you. It might appear to be confusing, but it is very, very logical. You are not to claim notional losses, but at the same time, you're not going to be penalized for withdrawal of the exemption that was available earlier, not after 1/4/2018. In that case, you would be penalized if I do not have a grandfathering clause. So if you understand the exact nature of the clause with reference to the exemption that was available earlier, you'll understand why 44AC was introduced. So I've got, since the total income is above rupees 2 crore, I'll have to pay 25% surcharge. See, we did discuss it. So up to 50 lakh, 10%, 50 lakhs and above, 10%, Above 1 crore 15%, above 2 crore 25%, and above 5 crores it was 37%. So my income is about 2 crores. Since the income of the assessee is about 2 crores, she would be liable for a surcharge of 25%. But understand there is an amendment which was made later on after the announcement was made, and the amendment was that in respect of income arising from 111A, taxable under 111A and 112A, both related to equity shares, the rate of surcharge would never go beyond 15%. The rate of surcharge, even if the surcharge on normal income is 25%, the rate of surcharge on these two special income would be only 15%, restricted to 15%. So now this restriction would happen only in case of income where the income of the assessee exceeds 2 crores or 5 crores. In all other cases, the rate of surcharge is anyways 15% or less than 15%. So with these two heads, you don't have to think. But when the income exceeds 2 crores or 5 crores, you have to keep the rate of surcharge in case of income covered by 111A and 112A at 15%. So what I've done here is, I've computed surcharge at the rate of 15% on 9,600. Add education cess to it, the total tax liability is 11,482. Thereafter, in respect of income covered by 112, right, that is normal long-term capital gain, the rate of surcharge is 25%. Here you need not take 15%. The 15% rate, maximum capping of 15% rate is available only in case of surcharge, only in case of income that is governed by 111A and 112A and not by 112. And the normal rate is 25%. And therefore, her total tax liability of Geet would be 1 crore 2,73,032. Right. Now coming to the question of Sanjay, whether the benefit of marginal relief would also apply to income above rupees 2 crores. The answer is yes. If we make it 2 crores and 1 lakh, we still have marginal relief, and the marginal relief is more. Look at this. It is 5,11,000 rupees of marginal relief when it exceeds 2 crores, because when you look at the incremental cost from 1 crore to 2 crores, it is 10% of the tax amount, and therefore you have a higher marginal relief as you go ahead. Had it been more than 5 crores, the marginal relief would be much higher, right? Because the incremental cost is 12%, right? The surcharge that increases from 25% to 35%, 37%, and therefore when it is 1 crore, 5 lakh and 5 crore and 1 lakh, you claim a marginal relief of 17 lakh 11,000, right? I hope you're getting this, everybody, friends. The method of computing the amount of tax, the marginal relief, the grandfathering clause, the very important 115 JC, which could come in the problem, and you would not even realize you would compute an erroneous tax if you overlook 115 JC. I hope I've made myself clear. You have been very, very patient. Thank you so much, friends. So we declare this as complete as far as the taxation is concerned, and as far as the total income, computation of total income and the tax liability. Any questions? I could take up some questions. Well, Shaikat is asking, under section 44 ADA, income less than 50 lakh can benefit presumptive taxation. Presumptive income. Yes, right. Shaikat, it was not available. It is probably with reference to the previous question in case of Mr. M. In case of Mr. M, ADA is not applicable because the professional fees is about 50 lakhs. Alright friends, I see there are no further queries. Thank you so much. We continue with TDS related provisions tomorrow, TDS and advanced tax. We have another 2 lectures to come up. We are going to take up TDS by way of question and answer so that it would not only become interactive, but it would become simpler. TDS is like more of procedural in nature, and therefore we take up question and answer instead of descriptive provisions, which could probably end up confusing you. Thank you so much. Continue tomorrow.